We have two types of doc stamps. So we have the doc stamp on the deed, we have the doc stamp on the note, and finally we have one that's not really a documentary stamp tax, but it's also charged in a closing of a transaction, particularly with new mortgages. We'll talk more about what this is. It's the intangible tax. So ultimately, three different taxes that have to be charged anytime a property is being transferred or there's financing occurring. And that's what we're charging these for. So this is charged for the transfer of property. The documentary stamp tax on the note, this is for, we can think of this as the transfer of money, the transfer of financing. And the final one for the intangible tax, this is basically for any new financing. So anytime a property is being transferred through a deed, we're going to charge our documentary stamp tax on the deed. This is anytime you're selling a property, you're using a deed to transfer the property, that deed has to pay the documentary stamp taxes to be recorded. Now, with the documentary stamp tax, always charged on the sale of the property. Now, if you remember the deed is the document that delivers ownership. So the deed is the document that delivers ownership, delivers the title, that concept of ownership to the buyer. Without the deed, you're not the owner of the property if you never received a deed to the property through normal transfers. So the documentary stamp tax on the deed has to be paid. And basically with this, it's based on the purchase price. So whatever you're acquiring the property for, that's what the documentary stamp tax is going to be. On the deed, it's going to say what type of valuable consideration you're using to transfer the property. So what type of valuable consideration is being used. And that's basically going to be the dollar amount. So what the dollar amount that's being transferred actually goes through. So this is based on the price that's recorded on the deed, the valuable consideration. And the other thing that you want to know is that we're dealing with 70 cents for every $100. So we have 70 cents for every $100. So the key thing is to sum this all up. It's anytime we're transferring property with a deed, it's based on the price that we're finding on the deed, and the charge is 70 cents for every $100. Now actually if you're in Miami County, Miami-Dade County, it's actually only 60 cents for each one of these, but exam purposes, I probably wouldn't worry about the 60 cents so much for Miami-Dade County. It'll probably list the county in there, but very rarely you're ever going to see Miami-Dade County. I've yet to hear anyone tell me they've seen Miami-Dade County on there, but just in case, it's actually 60 cents for Miami-Dade County, 70 cents for everywhere else in Florida. Miami-Dade is special, so they think. So for our documentary stamp tax on the note, this one's a little bit different. It's the same type of concept that we're buying those stamps. So if you visualize again that stamp that we showed up on the screen here. So again, we're purchasing that stamp, but now it's based on the transfer of financing. So what that means basically is anytime there's money being transferred. So for new loans and old loans or assumed mortgages, anytime there's a new loan being created or an assumed loan, an assumed mortgage, you're going to charge the documentary stamp tax on the note. And now with this, as far as the way this works out, is it's 35 cents. Which, easy way for you to remember how much it costs, it's half of the 70 cents, and it's the same thing for every $100. So the documentary stamp tax on the deed, that's 70 cents for every $100, but that's based on the purchase price. The documentary stamp tax on the note is 35 cents for every $100, but the key thing is here, of loan. The purchase price doesn't matter for our documentary stamp tax on the note. It just matters what the actual transfer, what the financing actually looks like for this. So it's the stamp tax on the note, the stamp tax on the loan. Remember the note, just like the deed is the document that delivers ownership, the note is also referred to as the promissory note. This is the promise to repay. So when you're taking out a mortgage, you're signing off on this promissory note that you're promising to repay this debt. And so the amount that's recorded on the note isn't the purchase price, it's the loan amount. And that's what's being taxed here. It's based on how much that loan is that's being created. So that's going to be our stamp tax on the note. Now for our final one, the intangible tax. So with the intangible tax, this one is 2 mils. So the intangible tax is $2 million, and it's only for new financing or loans or mortgages or whatever it is that we're calling it. But these are only being charged for the creation of a brand new intangible product. That word intangible means not real, and a loan isn't something, you can't go to a store and pick up a loan off of a shelf. It's something not real that you can't necessarily touch and feel. That's what we call an intangible. That's why this is the intangible tax. It's a tax based on new loans that are created. They only have to be paid when the loan's initially created. You can almost think of it like a sales tax almost for purchasing this loan off of a shelf. And as far as 2 mils go, you want to remember how to convert that to a decimal. We go 1, 2, in 3 places to the left. So remember your little swoopy line. So what that's going to look like is 0.002. So you have 2 mils for whatever the new loan amount is. That's our intangible tax, only on the new loan. If there's any assumed loans, you're also going to calculate the new and assumed loans on the documentary stamp tax on the note. But if it is a new loan and only a new loan, you're still going to charge the doc stamp on the note as well as the intangible tax. If it's only an assumed loan, you're just charging the documentary stamp tax on the note. And if you have a combination of the two, then again, you're going to appropriate it as necessary. For your new loans, you're going to charge both of them. For your assumed loans, you're just charging the documentary stamp tax on the note. So the financing taxes get a little bit more complicated than the documentary stamp tax on the deed. The documentary stamp tax on the deed is pretty straightforward. And the documentary stamp tax on the deed, this is typically paid for by the seller. And you remember, in order to deliver a general warranty deed, it has to be a transferable deed. If you don't pay the taxes on it, it's not really transferable. So this is typically a cost of the seller. However, in the real world, this could actually be paid for by the buyer if they negotiate it out that way. So if you do the negotiations, you'd actually set it up for the buyer to pay the doc stamp on the deed. But typically, it's going to be paid for by the seller. And then for all of our doc stamps on the note and the intangible tax, this is based on the financing. And whose financing is this? Or even if it's an assumed loan, who's taking over this financing? Whose financing is it going to be? It's the buyer's. So these two costs are typically associated with our buyer. So our seller is going to be having to pay the doc stamp on the deed in most cases, and our buyer has to pay the doc stamp on the note as well as the intangible tax, depending on whether it's an assumed or new mortgage. Again, if it's assumed, you're only charging the doc stamp on the note. If it's new, you're going to be charging the intangible tax as well as the doc stamp on the note. And remember, you have to buy enough of those stamps. For every $100 worth of value on the property price, you're going to have to buy, the seller would have to pay 70 cents for every $100 worth of value. We're going to be doing some specific math solving that out. For the documentary stamp tax on the note, the buyer typically would be paying 35 cents for every $100 worth of the loan amount. And then our intangible tax is the real easy one. It's just 2 mils of the intangible tax. You're just multiplying the 0.002 by the loan amount. But we will do some math through that so you guys can go through and see how that is done. So we're going to take a quick break here, and when we get back from this short break, we will get into detail on solving out the doc stamp on the deed, the doc stamp on the note, and the intangible tax. We'll actually have a little bit of a word problem we could go through and solve, and we'll work out this math. It's really not that bad. This seems really intimidating, but stick with us because we'll make it easy. I'm John Carissimo. You're watching Ask the Instructor.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment.
Hey, I'm John Carissimo, and I'm here to tell you about State of Real Estate. This show is going to be live every Friday at 12 noon Eastern Time, and this is going to be a show for you guys to chat in and get interactive live with us to help mastermind and build your real estate business. So make sure you tune in this Friday at 12 noon Eastern Time. Again, that's Fridays at noon Eastern Time. You can find the links in the description for this video. Look forward to hearing from you on Friday.
After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to Ask the Instructor. Every Wednesday at 12 noon Eastern Time, we come to you to help you understand in much greater detail so you really could kind of knock these things out, whether it's on your exam or you're trying to do these calculations out there in the real world. There's plenty of instances where you need to know how to calculate stuff like this in the real world. Sure, you could have somebody else do it, and a lot of time there are other parties that are designated to do this. In the real world, typically the title company is going to handle all of this, but if you want to be the most knowledgeable, most helpful professional for your clients, you want to be able to describe some of these costs. Maybe you don't have to be able to calculate them out so much like this, but when you're dealing with these numbers, it helps you greater understand what this charge is. When you're working with a buyer, and your mortgage loan originator might come in with some of these financing taxes and help kind of explain that as well. But again, the more you know, the more valuable you're going to seem to your client. So before we went on break, we were covering what these different doc stamp taxes are. We have the doc stamp on the deed. This is typically the seller's expense because it's the seller's deed that they're transferring, and this is based off of the price that's on the deed, since the deed is what transfers our ownership of the property, and this is going to be 70 cents for every $100 worth of value on the property. For a doc stamp on the note, this is going to be for the transfer of financing. So basically anytime you have a brand new loan or an assumed loan and that's being transferred, that's where we're going to have our doc stamp on the note needing to be calculated. The doc stamp on the note, it's charged at 35 cents for every $100, but the key thing is the loan amount. It's $100 every 35 cents for every $100 worth of loan amount, not the purchase price. This one's based on the price. These ones are based on the financing. And then finally, we have our intangible tax, which this is $2 mils for every dollar, or for whatever the cost is of the new loan, and the new loan only. That's really the emphasis that you want to have here, is this is only on the new loan. The doc stamp on the note is on new and assumed mortgages. So let's start off with some easy ones here. First one we're going to be doing, let's say that you have a seller who's planning on selling their property at $300,000. So your seller's planning on selling their property for $300,000. Let's go and label this up here. And this property, let's say it's located right here in Hillsborough County, so we don't have to worry about that 60 cents for Miami-Dade County. And the seller wants to know what it's going to cost them in doc stamps on the deed. And this, again, is typically paid for by the seller, but in a negotiation, it could always be negotiated out to kind of move money around. There's all kinds of stuff you can do in negotiations to get a win-win scenario, and this could be one of them where you're having the buyer pay for these maybe, but typically this is the seller's responsibility in the transaction. So the seller wants to know what the doc stamps on the deed are for $300,000 purchase price. So this one, it's going to be some pretty easy math that we're having to do here. All we're going to do is take our purchase price of $300,000, and now we need to find out how many stamps we need. Now, like I said, let's put this back up here on the screen so you can kind of see what the stamp looks like again. So again, this is what a stamp looks like in Florida. Now, this is a much older one. We don't really use these actual stamps, but essentially, if you want to visualize this in your mind, that this is what you're purchasing, then great. But if you notice right down here at the bottom, it says $100 on it. So this stamp is good for $100 worth of value. So that's, again, just to help you visualize what this doc stamp looks like. Now, going back to our question, so we need to know how many stamps we need to purchase. Well, we know each stamp is good for $100. So we're just going to do 300,000 divided by 100. And real easy division or trick right there, you can just go ahead and take out those two zeros. And what we're left with is 3,000 stamps needed. So they need to purchase 3,000 stamps. And how much do the stamps cost? 70 cents each. So we're just going to multiply this 3,000 stamps that we need times the cost of each stamp for a deed, which is 70 cents. And this one we will pull out the calculator for. So we're just going to take our 3,000 and multiply it by 70 cents, and we're going to get $2,100. Now this isn't all of the seller's closing costs, but this is definitely a big chunk of one. The doc stamp on the deed. And this is where Florida government comes in and says, hey, you owe us $2,100 for the transfer of this deed. So the price, this is in theory. This is if it sells for $300,000. Now let's say the seller listed it for $300,000 and it didn't end up selling for except for maybe $250,000. So they listed it for this, but it sold for $250,000. The listing price does not matter. Now, you can see this is a pretty easy concept. This is a pretty easy question to solve. And if you do see a question like this on your exam, they'll probably try to complicate it a little bit. They'll throw in some alternate pieces of information, but ultimately you just have to figure out what it is that you need. If it's asking for what the seller's cost would typically be, then you're just looking for the doc stamp on the deed. And they'll probably throw in some additional information. They might put in the listing price. If they put in the listing price and the sale price is what you want. The listing price means absolutely nothing. They could list it for $1 million, but if it only sells for $100,000, the $100,000 is going to be what we're paying doc stamps on, not what it was originally listed for. Because remember, this is based on the deed. It's doc stamps on the deed, and the listing price isn't going to be found on the deed. It's only going to show what the sale price is on the deed. So that's basically what you got to pay attention to right there. Is this is just going to be based off of the purchase price of the property. But you see, math is pretty easy. You just divide whatever that price is by 100, multiply it by 70 cents, and you get $2,100 in doc stamps. That would be your total cost for that, $2,100. So let's go ahead and complicate this a little bit. Let's try one that's a little bit more different. Let's say, again, we're talking to the same seller, and they say, well, what if I sell it for $300,000? And we go through and do that math, and okay, it's about $2,100 that would cost. And then let's say we go through, that was what we listed it for, $300,000, but let's say we don't sell it, except for maybe, let's say we get it for, let's say they get a pretty good discount on it. Let's say it's $279,999. So they're getting these extra little nines in here. Make them feel good, like they're getting some extra money, make them look like it's $280,000, which it basically is, except for $1. So this is our price. And again, we're looking for the seller's cost. We're trying to find out how much the seller's having to pay, or if the buyer's negotiating to pay this, what these doc stamps on the deed would look like. Maybe for this price reduction, the buyer said, hey, I'll pay your doc stamps for you, or I'll pay all your closing costs for you if you sell it to me for this amount, which, I mean, that's definitely happened before. A lot of different reasons that could come into play there. So you take this price of $279,999, and we're going to go ahead and again divide this by 100. And this is going to tell us how many stamps we need. So this is essentially like moving 2 decimal places over. So we're going to have 2,799.99 stamps. Now, if you've ever gone to the post office and you need to mail something, or wherever you're using stamps, if your letter is too heavy, meaning that little American flag stamp or whatever kind of stamp it is you're putting on there isn't enough to cover the postage, you can't just rip off another piece of stamp and stick a corner of a stamp on there and expect them to accept it. You rip that stamp in half, it's no longer good. It's not a good stamp. So it's the same rule applies here. Remember this stamp. We can't break off a piece of this stamp. This is what our stamp looks like. We can't break off a piece of this stamp and make it for $50. We can't tear it in half and make a $50 stamp instead of just the $100 stamp. So we can't have that. So what we need to do now is round this up. So we need to go from $2,799.99 and just round this up to the next whole dollar, and that's going to kick us up to 2,800 stamps. Now the trick here is we're never going to round down with stamps, because the government, if you're at all over this threshold of $2,799, even if it was 0.01, we still would round up. We'll do another one of those right after this so you can kind of see that. So we have these 2,800 stamps that we need to purchase, and again our cost of these stamps is 70 cents. So we're just going to go ahead and punch that in our calculator. 2,800 times 70 cents. And we're going to get 1960. So $1,960 in stamp taxes. So that's how much we'd actually have to pay in taxes for this. Now let's try one more, and then we'll go ahead and take a quick break here. So let's say now the purchase price is, we'll pick a weird number, $257,001. So $257,001. Again, what we're going to do is divide this by 100. So 257,000 divided by 100, we move over 2 decimal places. No, skipped over. You can see how these swoopy lines are very telling in case you move too many over. So that's going to end up being 2,570.01 stamps. Now this is where most people go wrong, because normal rounding rules tell you would round down, because anytime you're less than 0.5, you're typically rounding down, right? That's the rule. Wrong, because we can't cheat the government out of their stamp. They want that extra 70-cent stamp. So yeah, it's not the biggest deal, but they're nitpicky about things like that. So what we have to do is you always round up. That's the key thing here. Always round up. And even if it's 0.01 like this, we're going to round up. So it's 2,571 stamps that we're really going to need. Again, we're going to multiply that by 70 cents. Take out our handy dandy calculator and go ahead and punch that in. 2,157, too many numbers. 2,571 times 0.70 gives us $1,799.70. Now this is okay to have a decimal, because this is how much it's costing us. Remember, like I said, we needed that extra 1 stamp in there, and that's why we have extra 70 cents there, because we charged an extra one of these stamps. We had to pay for an extra 1 stamp for that extra dollar worth of value there. So what that is, again, is $1,799.70, and that's going to be our total tax. Here it's okay to have a decimal. Here it is not. You can never have a decimal. You always have to round up. And that's going to be our doc stamp on the deed. Now, when we come back after the next break, we're going to go ahead and cover the doc stamp on the note. So this is a little bit more complicated with the doc stamp on the note, but it's ultimately the same major principles that we're covering here. So stay with us. I'm John Chrismo, and you're watching Ask the Instructor.
Did you know that the Florida real estate license exam usually averages a 50% pass rate? The good news is that you have the opportunity to be a part of the passing 50%. The Florida real estate exam covers 3 main areas: real estate principles and practices, Florida real estate laws, and general real estate laws. Our exam review class focuses on reinforcing the key concepts of these areas in a fun and engaging way. You'll also learn valuable exam strategies and get lots of practice with real estate math problems. This course includes our exam prep textbook that contains over 600 practice questions to help you prepare for the state exam. And we're so confident that we have the most comprehensive exam prep courses in Florida, we back all of our students with our exclusive 1-year retake guarantee. Our class sizes are limited and tend to fill up quickly, so reserve your seat today. Registration is easy and just takes a few minutes on our website, tampaschoolofrealestate.com. You can also stop by our administration building or give us a call at 813-928-0106. Our advisors are standing by to answer any questions you have about preparing for your Florida real estate license exam and starting your exciting new career in real estate.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. Remember, this is every Wednesday, 12 noon Eastern Time. If you guys have questions, send them in to us. We'd love to answer them here live on the air to go through and really break this stuff down. Any of you guys that are watching along with us, whether it's on YouTube or Facebook, go ahead and put your questions that you have in the chat. We actually have a question, looks like it's coming in here, from Matt Fisher. On a $200,000 home, what would be the cost of the doc stamp? So let's go ahead and calculate that out. So we have a $200,000 home. And we'll dive one step further in this question as well here, and we'll actually figure out the credits and the debits, because this could also be very important, not just in the real world, but on your exam as well. This is typically half of the question, really figuring out whether it's a debit or a credit. If you've got the math down, you probably will still be left with about 2 answer choices if you can't get the debits and credits straight. So that's going to be important as well. So let's say that our home price is $200,000. Courtesy of our friend Matt Fisher over on YouTube. So if you guys again do have any questions, go ahead and send them into the chat. So we got those loaded up here. So we go ahead and answer your particular questions that you have. So $200,000 is our price. Now again, we need a stamp. One of those stamps for every $100 worth of value. So what we're going to do is divide this by 100. And again, that's essentially moving 2 decimal places over. So that's going to be 2,000 stamps needed. Now, here we don't have any decimal. We don't have any stamps that we need to extra account for here. If this was $200,001, again, it would be 0.01, and we have to round that up to 2,001 stamps. But since we have a nice even number here, we don't have to worry about doing any sort of rounding. Finally, we just had to multiply by the cost of the stamps. And this is the stuff that you're going to have to remember. That's almost kind of like the formula that you want to know for the exam. It's 70 cents for every $100 of value. Or I shouldn't say value, of price, because it's whatever price is recorded on the deed is going to be what this is charged off of. So this is the part that you want to know for the exam. It's 70 cents for every $100. You divide the price by 100, you take the number of stamps, which is that price divided by 100, multiply it by 70 cents. And when we plug this one into our calculator, we should get $1,400. So our cost would be $1,400. That's how much these stamps would cost. Now, who typically has to pay for this? This is typically the seller. So if it is the seller paying for this, which this is typically how it'd be done, if it doesn't say otherwise on your exams, you always want to assume that this is being paid for by the seller. What this is going to look like, so let's do a quick definition of our credit versus debit. So a debit means you pay. A credit means you receive. So debit is when you pay, a credit is when you receive. Now, on the exam, or on a closing statement, so the closing statement records all of the transfer of money between parties. So if somebody's receiving money, that's going to be a debit. Or if someone's paying money, it's going to be a debit. And if somebody is receiving money, that's going to be recorded as a credit. So let's think of who's on our closing statement. We have our buyer and our seller. They both have separate parts of the closing statement. The state of Florida is who's getting this money. They're not on the closing statement. So for that reason, we're not going to have any credits because this is crediting the state of Florida. State of Florida is not on our closing statement. So this is going to be a $1,400 debit to the seller. And if the buyer negotiated for them to pay this, then it would be a debit to the seller. But it's always going to be a debit. All these doc stamps are always going to show up as a debit, never a credit. The person being credited for this money is the state of Florida. So that's going to be a $1,400 cost or debit to the seller. So that's our doc stamps on the deed. Hopefully that helped you out with that question there, Matt. The next one we're going to go ahead and talk about is doc stamps on the note. Now, if you missed the beginning segment, make sure you go ahead and rewind back through this and watch the beginning, because we kind of really defined when you're going to be using each one of these. But again, just to recap, the doc stamp on the note is going to be charged for any mortgages. So any mortgages, we're going to have to charge the doc stamp on the note. Whether it's a new mortgage or an assumed mortgage, we have to charge the doc stamp on the note. And the doc stamp on the note, just like for the doc stamp on the deed, it's 70 cents for every 100. We're still buying a stamp for every $100, but now the stamps are not 70 cents. To record the promissory note, it's going to be 35 cents. So that's 35 cents, again, for every $100 worth of value, but value of the loan. So 35 cents for every $100 of the loan amount. And that's our doc stamp on the note. So let's go ahead and do another scenario here. Let's say that we have a buyer that's looking to take out a loan on a property that cost $300,000. The loan that they're taking out on this property is, let's say it's $150,000. They're doing half of it loan. And it's a new loan. So a buyer is looking to buy a $300,000 property, and in order to do that, they need to take out a $150,000 loan. What would be the documentary stamp tax on the note, and how would it be recorded on the closing statement? So that's maybe how you might see a question, whether in an exam simulator or actually on the exam. It'll probably be worded in a similar fashion to that. Like I said, this is another easy concept. So they like to put in distractor information. The price is completely irrelevant for the buyer, even in the real world, because the seller typically has to pay for the tax on the price. We're just dealing now with the tax on the loan or on the note, because on the note, it's just going to have the loan amount in there. It's not going to have the price. It may have the price in there somewhere, but the face value of that note is going to be the $150,000 loan. So the way this works, it's very similar to our doc stamp on the deed. The first thing is dividing by 100. So we again move 2 decimal places over here, take out those 2 zeros, and we're left with 1,500 stamps. And now the only thing that's different is we're not charging 70 cents per stamp. It's actually only 35 cents per stamp. So we're going to take that 1,500 and that's going to be $525. So $525 is going to be the cost of our documentary stamp tax on the note. Now, let's go ahead and try to complicate this here. So again, let's do one just like we did with the stamp tax on the deed. Now I'm not going to waste your time telling you about the price, but just remember the price does not factor in for calculating the stamp tax on the note. It's based on the loan amount. So the questions, like I said, it's an easy math for this here. So they try to, the easier the question is, the more they try to complicate the question, more difficult they make it sound when it's really just an easy solution like that. So that's where you want to be able to pick out what you need, and that's always the loan amount when we're dealing with the buyer's transfer taxes. So let's say now that we have a $151,110 loan. Make sure my writing lines up with my words here. So $151,110 loan. And what is the stamp tax on the note? Again, what we're going to be doing, and it doesn't matter whether this is a new loan or it's an assumed loan, you're going to do it the same way. So we have a $151,110 loan. We're going to divide that by 100. That's 2 decimal places over. And you'll know, what do we see here? We have another decimal. We have 1511.1. So we need 1,511.1 stamps. Again, can we break off a piece of stamp and use that? No, we have to buy a full stamp. We can't break off a piece of stamp and then take the rest of the stamp and say, hey, I got a stamp here that's good for $99. Anybody want to buy it? No, they're not going to do that. So what we need to do now is always round up. So we're always rounding up. So that 1511 is going to turn into 1,512 stamps needed. So we're going to take our 1,512 stamps that we need, and now all we're doing again is multiplying by 35 cents. So again, we'll punch that in our calculator. 1,512 multiplied by 35 cents, 0.35, and we get 529. So this is going to end up costing the buyer for the doc stamp on the note $529.20. So let's try another one. Let's do a compound question here. Let's say that the buyer is assuming in a mortgage, so we have an assumed loan of, let's say it is $25,000, and we have a new loan of, let's say, $80,000. Now, in most cases, you could add these together and just deal with one loan amount, but there are some rare instances, especially when you don't end in zeros like this, where that's going to completely give you a wrong answer. Not completely, you're only going to be off by one stamp in most cases, but we want to avoid that. So what we're going to do to handle this to make sure we're right 100% of the time is do these as two separate problems. But whenever you have the multiple zeros like this in the end, you could usually combine them together. But we want to try to keep things simple here. It's really the same math, so it's just a little bit of extra work. We're not going to be lazy, so that way we don't have to worry about understanding this and when these numbers work. You play with them enough, you'll start to get it when you could combine them together and when you can't, but it works 100% of the time. If you do it twice, it just takes a little bit extra work. So what we're going to do is figure out how many stamps are needed for both of these here. So we're going to divide our top one by 100, divide our 80,000 by 100, and what that's going to end up giving us is 250 stamps for the assumed loan and 800 stamps for the new loan. So we have 250 stamps needed for our assumed loan, 800 stamps for our new loan, and the way we're figuring that out is everything what we've been doing so far, just taking that loan amount and dividing it by 100. Very important, I can't stress this enough because I see this happen quite a bit, is where you're using the purchase price as one of these numbers. Purchase price, completely irrelevant here. So what we need to do now is just multiply each one of these by 35 cents. And then what we're going to do is add the two of these together once we have them. So let's go ahead and first do our assumed loan, which is 250 stamps that we need times 35 cents, and that gives us 87.50. 0.5, the extra zero there since we're dealing in dollars and cents. So $87.50 is going to be the stamp tax on our assumed loan. For our new mortgage, we're going to do the 800 stamps that we need times 35 cents, and that gives us 280. So we have $87.50 for our assumed loan, $280 for our new loan, and now what we have to do finally is just add the two of these together here. We're combining the two of these to find the total tax, and so that's going to be $280 plus $87.50, and that's going to be $367.50. And now finally the big question, the non-mathematical question, really the concept question, is how does this appear on the closing statement? Well, we know it's not going to be a credit because the only person being credited with this here is the state of Florida. They're not on the closing statement, so it's only going to be a debit. It's not like the prorations where you see a debit to the seller and a credit to the buyer. It's only one, and it's going to be a debit, and this is typically paid for by the buyer, so it's a debit to the buyer. So that would be a debit to the buyer. Now finally, let's go ahead and do our intangible tax. So for our intangible tax, again, just to recap, if you missed this part, go back to the beginning of the episode, go ahead and do the rewind in there so you go back and rewatch that stuff because we really broke down what each of these are so you know when you can use them and when you need to use them because that's really essential with this here. So we have our intangible tax. This is only charged on new mortgages. So the intangible tax only charged on new mortgages, and it's 2 mils. So it's a 2 mils. A mil is a tax for basically it's a small percentage. It's 1/10 of 8%. So basically what that's going to look like as a decimal is 0.002. And ultimately that's the number that you're going to want to remember for the mils is it's 0.002 on our new mortgages. And what that means is all you're doing is taking the new mortgage, multiplying it by 0.002, and you got your answer. So let's go ahead and put some numbers in here. let's say we have a $100,000 loan. And again, the key thing here is this is a new loan, because we're only charging this on a new loan. If a loan is assumed, we're not charging the intangible tax. So all we're doing is taking our loan amount. What we're going to do is multiply it by 0.002. So make sure you have the right amount of zeros in there. It should be 2 zeros, so 0.002. That's our mils. To turn from mils to a decimal, it's 3 decimal places, so it's 0.002. And then we're just going to plug this in, 100,000 times 0.002. And I believe this should be $20. 100,000 times 0.002, and we get $200. So our intangible tax is $200. And again, how is this going to appear on the closing statement? This is going to be a debit to seller or buyer. Well, it's the buyer's financing, so it's a debit to the buyer. And that's our intangible tax for you. This one's really the easiest out of all of them, but it's usually not by itself where it's asking you to calculate the intangible tax. It could just be an easy question just like this where that's it, you're done. 100,000 times 0.002, you get $200 and boom, you have your intangible tax all calculated out. You just have to make sure it's the new mortgages. If it says there's a $100,000 new mortgage and a $200,000 assumed mortgage, we don't care about the assumed mortgage. We only are charging this based on the new mortgage. But now, like I said, with questions like this and in the real world, you're not dealing with the intangible tax alone with financing. It's the intangible tax combined with the stamp tax on the note. So we're going to take one last quick break here, and when we come back, we're going to solve one more longer type of problem here. We might even have time for two, where we're going to work in our stamp tax on the note and our intangible tax to find the total cost a buyer would have to pay at the time of closing for these transfer taxes. I'm John Chrismo, and you're watching Ask the Instructor.
Are you considering getting your real estate license via one of our classroom courses? At the Tampa School of Real Estate, our courses have been designed to prepare you for the Florida Real Estate Commission licensing exam, as well as teach you about the fundamental aspects of the real estate business. In this class, you'll learn about appraising property values, real estate contracts, the mortgage industry, and much more. We offer multiple class formats and several locations to make getting your real estate license easy. You can complete the course in as little as 2 weeks in one of our day classes. Or if you have a busier schedule, you might prefer our evening classes. All of our classes include the course textbook as well as other supplemental materials. At the Tampa School of Real Estate, all of our instructors undergo a rigorous training program and have real-world real estate experience in order to best prepare you for the class and state exam. We are so confident we have the most comprehensive licensing courses in Florida. We back all of our students with our exclusive 1-year retake guarantee. Our class sizes are limited and tend to fill up quickly, so reserve your seat today with a $49 deposit that will apply towards your course tuition. Registration is easy and just takes a few minutes on our website, tampaschoolofrealestate.com. You can also stop by our administration building or give us a call at 813-928-0106. Our advisors are standing by to answer any questions you have about obtaining your Florida real estate license and starting your exciting new career in real estate.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate, 12 noon every Wednesday, to help you further understand these concepts that are not only crucial to passing your real estate exam, but also very helpful for you to get a greater understanding of the real estate industry in general and how these costs work out, so you can better understand and explain these. Undersplain, that's a combination word I'm trying to trademark here for understand and explain. So understand and explain for your clients. Let's go ahead and try a more difficult one. Before the break, we covered the intangible tax. If you missed that, like I said, definitely go back and rewatch that. Make sure you have that down pat because that's very likely to show up on your exam. You're definitely going to see it in the real world anytime you have a client that's doing some sort of financing. So this next question, I promised you I was going to give you a tough one here. And what we're going to do is go ahead and combine together now multiple types of taxes. Yeah, that's right. This is going to be don't psych yourself out. Don't psych yourself out. This is an easy concept. It's easy math. We're just having to do it a couple of times here and mix together a couple types of math. So it's going to seem like it's a lot, and you're going to look at this and say, whoa, how am I going to be able to solve this question here? Let me just give up. Let me just choose answer C, or let me just tell them it's going to cost this much, and hopefully I'll be close with that, or let me go use a calculator online. Calculators online, that's probably the quickest way to get through these, unless you start to really become a pro. Watch this episode enough times, try it on your own enough times, you'll be doing these in your head while you sleep. So let's get into the question here. Let's say that we have a property value. So a buyer is looking to purchase a property for $500,000. So buyer's looking to buy a property that costs $500,000. In order for them to purchase this property, they're going to assume a $10,000 loan. So we have a $500,000 price, they're assuming a $10,000 loan, and they're taking out a new loan for 70% loan to value. And you might be saying, John, are they really going to do that? Are they really going to make you calculate the loan to value just to figure out what the new loan amount is? Answer is yes. Number one, they want to see if you know how to calculate loan to value. They like to compound these into multiple questions all together here. But then on top of that, they also want to see if you even know to pick up on this and if you even know what loan to value means. At the very least, you should know that this means that there's a second loan by seeing there's an assumed loan and a new loan. And now finally, what the question's asking. So we have our buyer that's looking to buy a property valued at $500,000. They're taking out an assumed loan of $10,000, and the loan to value for the new loan is 70%. We're going to have to do some calculations to figure out what that loan to value is. Finally, the question is asking, what are the buyer's taxes? So we have $500,000 purchase price, $10,000 assumed loan, 70% new to, loan to value loan, and the buyer, and we're trying to find out what the buyer's taxes are. So a lot of information here. Now, easy one we could pick out. So with the buyer's taxes, let's figure out what we need to work with first here. Because that's really, before we try to pick apart this question and just jump right into it, don't jump the gun quite yet. First, ask yourself the question, what is it they're asking for? Yes, we know it's the buyer's taxes, but what does that mean when they're asking for the buyer's taxes? That means the doc stamp on the note and the intangible tax. So the doc stamp on the note and the intangible tax are the two that we're looking for. One and two, the doc stamp on the note and the intangible tax. We need to find those. That's what we're trying to find when we're looking for the buyer's taxes, the buyer's transfer taxes on the property. So we could already figure out what our assumed loan is. That's $10,000. So we have that information. That's good information that we're going to need. Let's go ahead and circle that out of there. And we also need these two things that we're looking for here. Now we need to figure out what this equals. What this 70% loan to value actually equates out to. So what this is going to break down to is trying to figure out this loan amount. And first we have to think of what the loan to value ratio is. If we look at this loan to value, anytime you see something to something ratio, that means the 2 is simply a division sign. So that 2 that we have in there is just a division sign. So what we need to be doing basically is taking our loan amount and dividing it by our value on the property. So we're taking our loan amount and dividing that by the value on the property. And if you really pay attention to that, you're not going to get led astray. Because what I've seen happen before is saying, okay, well, the price is $500,000, but we already have the $10,000 assumed loan, so our value must really be $490,000. No, don't overcomplicate it. It's just loan divided by value. And normally we do loan divided by value to get our loan to value ratio, but we already have that ratio of 70%, so we just need to work backwards. We're not going to divide, we're going to multiply the 70 cents by the $500,000. So let's do that one now to figure out what our new loan actually is in a dollar amount, because we can't do 70% to figure this out. We need the dollar amount to calculate this. So we're going to do 500,000 times 70%. So put that in our calculator, 500,000 times 70%, and we're going to get $350,000. So now we don't really need this 70% number. We don't need the purchase price anymore because we have our $350,000 new loan amount. We have our $10,000 assumed loan amount. So let's go ahead and make this a little bit cleaner and just have the information that we ultimately need here. And when you can get to this information, the question is really pretty easy, pretty straightforward after this point. Really the tricky part is just trying to identify what we just pulled out of there. So we have our assumed loan, and that was $10,000. And we have our new loan, which was $350,000. So those are our two loan amounts, $100,000 and $350,000. I probably shouldn't have done that in the green so you guys would be able to read that better. Let's go put this here in black. So we have $10,000. That was our assumed loan, $350,000 on our new loan. So now we just have to do the calculations. Again, we want to look at these as two separate problems here. So let's start off with our assumed loan first. The assumed loan, are we going to charge the intangible tax? The answer is no. We only charge the intangible on the new loan. So on the assumed loan, we're just going to be dealing with the documentary stamp tax on the note, which is the loan amount, which is $10,000. $10,000 was our loan amount from the question. We divide that by 100 because we need one stamp for every $100 worth of value. And what we're left with is needing 100 stamps. So 100 stamps that we need, it costs 35 cents per stamp, and it's going to end up costing us $35 for the stamp tax on the assumed loan. So $35 is what we have so far in taxes that we've already racked up just on this $10,000 loan that we're taking over in this situation. Now the next one we want to calculate here, because we're done with the assumed loan basically at this point here. The assumed loan, we're just doing the stamp tax on the loan, and that's it, we're done. So let's move on to the new loan here. We've got that all completed. On the new loan now, we need to do the same calculation for our doc stamp. So we'll start off with our loan amount, $350,000. We're going to go ahead and divide that by 100, and what we're left with is about 3,500 stamps needed. And then finally, all we have to do is just multiply the 3,500 stamps that we need times 35 cents per stamp. And again, we'll plug this in our calculator, 3,500 times 0.35. That's going to give us $1,225. Let's double check that math there, make sure that makes sense. I think it does, times 0.35. Yes, $1,225. Always a good rule of thumb to double check your calculator, especially when you're entering in stuff quickly like I am there, because it's easy to end up with a number you don't want. So we have $1,225, and this is our stamp tax on the new loan. But we're not done yet. We have our stamp tax on the assumed. We have our stamp tax on the new. What are we forgetting? Our intangible tax on the new loan. So the intangible tax on the new loan is very simple as far as the calculation goes. It's $350,000, the new loan amount, times 0.002. And that's it, easy as can be. So that's $350,000 times 0.002, and we're going to end up with $700 in intangible tax. So finally, all we're going to have to do is add these together. We have our $700 intangible tax on the new mortgage. We have our $1,225 stamp tax on the new mortgage, and our $35 stamp tax on the assumed mortgage. So our last step, again, just adding them. So we're going to go ahead and put these all together. We have $35 plus $1,225 plus $700. And this is going to give us our ultimate total final cost, so 35 plus 1225 plus 700 gives us 1960. So $1,960 in total taxes for the buyer. Very important that you remember this as well, because this is half the question typically with these multiple choice questions. You'll probably see 1916 on there twice, but one as a debit to the buyer, one maybe as a debit to the seller, one maybe as a credit to the buyer, and one maybe as a credit to the seller. So really, it could be that same number. So you might not even have to do any of the math to figure out what the number is, and you just have to know whether it's a credit or a debit. And in this case, it's a debit, and a debit to who? The buyer, because this is typically the buyer's payment. So we have $1,960 debited to the buyer. And this is all of the doc stamps for the buyer and the intangible tax. And not really a doc stamp for the intangible tax, but it's charged at the same time for that intangible tax. So this is essential. This is crucial because you're very likely to see a doc stamp question not only on your class exam but on your state exam. You'll probably see it again in post-licensing on your broker exam. Whenever you take a real estate license exam in Florida, it's very likely you're going to see these doc stamp questions. These doc stamps have been around forever. Need I flash the doc stamp again? So that's what our little stamp actually looks like right here. So you can see this is a little dated as far as it goes, but that just means it's going to be very likely to be on your exam. It still has to get paid today. We're just not doing these little stamps that you see here. So that's our doc stamps on the deed, our doc stamps on the note, and our intangible tax. Hopefully this has helped you guys out with being able to solve these questions and understanding this in greater detail. If you're looking for more study tools, first and foremost, check out our other videos. We've got tons of other videos on here that you could look at that are just like this, where we have a lot of solving problems and explaining concepts and things like that. So check out our YouTube channel. But if you're looking for an even more comprehensive review, we have our weekend review classes. If you're not in the Tampa Bay area, because we do have those in a couple locations throughout Tampa, but if you're not in the Tampa Bay area, we get people watching this show from all over the country. We have tons of online resources for you as well. The best one is probably our exam bank simulator, where you could go through, and it's got a bunch of math problems just like this in there. You could go through and try out the questions, see what the questions are maybe worded like, and actually get to do some math problems like this. Either way, I mean, these videos might be enough for you. This might have been the last thing you needed to go out and pass your exam, so best of luck to all of you guys there that are taking your exam this week or in the near future. Remember to check back in with us next Wednesday at 12 noon Eastern Time. We're going to have another Ask the Instructor session here, where we're going to be going through solving more questions like this, helping you get better prepared not only for passing the exam, but also understanding the real estate industry in much better detail. Also, don't forget, this Friday, we have State of Real Estate. So that's every Friday at 12 noon Eastern Time. It's a great show. This is really what you want to watch when you're trying to grow your real estate business. Whether it's just starting or trying to grow from nothing to something, or you're trying to grow from something to spectacular, that's the show that you want to watch. We just did one last week on prospecting, and it was a great show. You should definitely go back and watch that, because prospecting is really essential to your success in real estate. But that's all I have for you guys today. Again, this show is brought to you by the Tampa School of Real Estate. I'm John Carismo, and thank you for watching Ask the Instructor. See you next week.